Thank you very much, Jerry. And yes, my trip to the US was a junket. It was a family trip for a wedding in California. So less fact-finding, more just sort of a social trip. And I also realised too I need to upgrade my resume that Jerry's reading. If you've done your maths quickly, I joined Westpac in 1999, which means I've been doing this job for over 20 years now. So I've seen a few cycles. I want to try and talk you through those so we think more about bigger picture rather than short run. Which is why I kind of picked this title, OPEC, US frackers or China, who is driving oil prices? I'm not about to come out here and say you should ignore OPEC. I think OPEC still matters. But it matters more for the short run, and I'll explain why. If you want to know short run volatility, OPEC does help there. But for the long run, you do need to watch more around what's going on in the US and China. China, now the big emerging demand, resource demand is centre. Of course, India is emerging in the background as well, so I can't run that many titles. And of course, US now matters not just from picking the demand cycles. US has always been great for picking the developed economies and how it's been moving and how demand's been moving. But now, the world's biggest oil producer, you cannot ignore them from the supply side as well. Bottom line is, there is no easy answer. The world's becoming more complicated. Overlay the issue of decarbonisation of the economies, rising new technology and competition, and you can see it's becoming really, really complicated. But I will argue, if you do want to reduce it down to something more simple, do focus on OPEC for the short run, US and China for your more medium run. Last year I did talk about supply disruptions fading. Just a quick recap that we were looking for oil prices to weaken. We thought the supply would continue to rise out of the US, and of course OPEC could not fight that rising supply. It turned out to be correct. What we missed was the global slowdown. We really missed the fact that Trump would ramp up the trade wars, really hit global growth, and the demand side would come under pressure. That is why our forecasts were looking at more, even though we were downbeat last year, we were not downbeat enough. We thought by this time we should be around 67. And of course, we're closer towards around 60. And as you can see, also back then too, we were talking about a much more upbeat economy overall. We were downbeat on Australia. We weren't talking about rate cuts, but unlike many other competitors, we had the RBA on hold. We could see a weak local economy here, driven by what was going on in the household sector. What we did miss, however, was the fact that the US would slow under this trade war impact, and we actually had rate hikes in the US, whereas now we're talking cuts and more of them. So it's a big shift on the global environment, which you overlay Australia, and it gives you a reason why we are even more downbeat on Australia. Just first up, the global economy, and I want to highlight sort of a rising a structural change, which really highlights the fact that if you're looking for the trade war to end soon, Christmas is coming too, and maybe you should wish for Santa. The reality is we've seen a big shift in the way the globe operates, and the world is now trying to find a new balance. If you look back to 1995, when China first entered the World Trade Organization and started big global trading, back then the US was the centre of global trade. Of course, Japan was involved, and the emerging markets in Asia, and of course, older markets in Asia. And of course, there was Europe, which centred around Germany. But of course, all those linkages actually centred around the US. And that is why back in those periods of time, I remember well, if you got the US right, you could generally get the global macro view right. Of course, that has now changed. Since China entered the global markets, you've seen China rise. You've also seen India rise as well too, but you can see what's happened here now. The world is now centering around two trading hubs. You've got the US and China both level pegging each other for being centres of global trade. Japan trades with all of them. They trade with all the fringe nations, and of course they all trade with Europe. You can see now that Japan is no longer the centre of Asian trade, but of course China is now. So Japan to some extent has been sidelined from this. So this is where the battle of these tariffs and trade lies. US is now trying to find this new balance with the rise of China being an equal competitor. And to put it into some sort of long-term historical context, those that think China's about to go away should remember that China is actually really only taking its rightful place. Population of 1 billion people, it deserves to have a share of global trade representative of what it is in the globe. It is returning to what it was pre-colonialisation. If you look at what's going on with the tariffs, you can also see that there was some reasons why the US was really unhappy. Those little purple bits at the bottom is the tariffs imposed on US goods and imposed on Chinese goods in US and China pre this trade war. And as you can see, and this is even excluding technology arguments, which I'll just touch on briefly. You saw the US implementing some new tariffs, and of course, then the Chinese responded. And on average, the tariffs in China were still, on the US goods, were still higher than the Americans. Now, there's some proposed implementation of further tariffs around all of Chinese imports that will bring the average tariffs for all Chinese imports up to 25%. Now, it's been a long time since we've seen average tariff rates that high on any particular country in the world. And of course, the Chinese is responding too, but they're constrained by the size of what they've already imposed, and they're now looking for something imperial. At the end, you'll see the two major trading partners of the world imposing tariffs on each other of around 25%. Ever since World War II, the world has been fighting to get global tariffs down, and the global economy has expanded on the back of that. We got tariffs on the average for the globe down to under 10% through the last decade. And that has seen global trade expand. So you can argue about the pros and cons of tariffs and what it means for individual economies and the nature of the economy, and you get these pros and cons of both. But unequivocally, if you're going to go into a world with higher global tariffs, it will change the nature of the way of global trade, and it will be slower global trade and slower global growth. You can see the response coming through from also the trade wars extended out to the European Union, and of course, European Union is responding as well, but that's a much smaller tariff war fight. As you can see, it's mostly around steel and cars. At this point in time, the tariff rates are clearly quite low and unlikely to reach 10%. When the US is talking about imposing tariffs on European cars, that's European car imports. Do remember, companies like BMW, Mercedes, Volkswagen have plants inside of US as well, producing cars. They will be tariff-free. So this tariff war is having a meaningful impact on global growth. The other one to remember too is China is not going to give up on its desire to become a first world nation. They've already managed to grow their share of patents, and new patents being issued, to a higher level than what the US is doing right now. Not surprising given a new emerging economy trying to do a lot of different things. But the US is not necessarily happy about foregoing this position and is fighting back. So, bottom line is, we've for a long time argued that we do not think the trade war route will implement itself into a full-blown reduction in global trade and full-time barriers. But the idea that we're now facing a global environment of higher tariffs and slower global growth is a reality we must face. And unlike previous times when we're in a high inflation environment, in this low growth, low interest rate environment, low inflation environment, it's not sparking the kind of inflation we've experienced in the past. It's helping to push it, but not the same sort of growth we had in the past. So our world growth profile is looking slower now. We now have growth slowing this year to 3.2, 3.3 the next year. It's not bad. It's hardly spectacular, but it's just highlighting the softer levels of growth. So message number one, we are not facing a global recession. We are facing slower growth. You will see China in those numbers actually slowing to 6.1 this year and then down below 6% next year. The Chinese administration is responding to try and stimulate growth, but in a much more pragmatic way, which I'll sort of highlight a bit. And of course, you see the US there, which we have now going down to 2.3 this year, and then sub-trend growth of 1.6 next. The trade wars are hurting. We do expect further rate cuts from the Fed to help. One of the perverse things that happens in this world still to this day and age is in times of global shock and fear, people head towards the safer assets, which tends to be US dollars, because a lot of investors are US, and they bring their money home. US dollar continues to strengthen. So even unless the Fed operates directly into the market in some way, even with the Fed cutting rates, the US dollar can remain reasonably firm. It will weaken as the US cuts, but it's bounded by who do you buy. In this environment, would you rather hold euros, yuan, yen? US dollar gets a better support than it otherwise should. Oh, and of course, just quickly too, you do see we have Australia growing sub-trend this year. That is really around the housing story and the investment story that is very quite benign. That consumer-led per capita consumption recession, that is, we have not seen incomes or consumption grow per person for almost a decade now, is very real and now really starting to bite. First of all, in the global trade environment, we are seeing things dip down. We were worried that this would happen in the trade war environment, and it's becoming increasingly so. Business surveys around the world are telling us that the orders for imports and exports are now starting to go backwards. They're now dipping below the 50 mark. which means we're in a contraction zone. We're not in the GFC environment. We're not quite as bad as we were in 2012, but it is highlighting that that negativity is flowing through, and it's flowing through the production cycle. The production cycle globally, business investment, along with industrial production, is now slowing. That is very much around these trade war fears, even with the Fed cutting rates, the ECB talking about more liquidity introductions, and the Bank of England also doing so. You can see why it's happening. That global trade battle is impacting on Europe. Of course, Germany's still doing okay, but the external environment's becoming a negative for it. And we now see Europe now beginning to grow slow as their exports become a negative. That is, they're importing more than they're exporting. That environment will continue to grow in this environment. So Europe continues to slow around with all their political problems they're also facing now, particularly here in the south, around Italy. So Europe is not driving growth. US is remaining quite stagnant in their growth patterns, but most importantly, their business investment growth through the year is now slowing quite dramatically. It's looking like it's going to actually flatten out by the end of this year. That matters because strong employment growth has been a bedrock of the US economy for some time now, getting the unemployment rate down to levels not seen since the 1960s. In fact, if you want to talk about issues the US now faces, it's the first time since the 1960s that we're facing an environment with a current account where the government budget balances are blowing out at such a low level of unemployment. Last time was during the Vietnam War. I was just in primary school, well, not even in primary school. So you can see now we are starting to be concerned about the growth rates in the US and why we're talking about there's more Fed rate cuts to come. And of course in China, they are making the shifts towards trying to stimulate growth through the state-owned enterprises, but it's constrained. Already those state-owned enterprises through the local governments are incredibly highly leveraged. There's limited scope for how much they can spend, limited amount they can make up for the private sector being hit by these trade wars, reducing their investment. Also, the Chinese have announced they're going to remain tight controls around property in China. They're not wanting to allow another housing bubble to get away from them again. Yes, they're doing what they can to try and offset the trade war, but it's very pragmatic, focused and isolated, i.e. they're trying to make sure they don't create problems further down the track. They are not going hell for leather to stimulate growth. This is another reason you'll see the environment globally softening. Now, just focusing quickly on what's going on in the crude markets in the time left, what I really need to focus on, is I will highlight, is we can't ignore the transition that's happening right now. It is very real. It is both driven by around, I guess, economic political events, focusing on decarbonising the global economy, but also around economic events. That economic events are the improvements in technology. The costs of renewables are coming down, and they're becoming increasingly competitive. You will notice that the forecasts are by 2040, renewables will make, including hydro renewables, will make 40% of global power supply. That's really changing the market for things like coal. And of course, electric cars and trucks are beginning to displace more and more transport infrastructure. And in countries when you have places like China directly forecasting and directly managing their economy in that direction, given that is now the world's biggest transport market, car companies are focusing on producing for that market. We are going to see the flow-ons. And Donald Trump can do what he likes to try and stimulate the rise in the consumption of the gas guzzler in the US. Global forces will see car companies focusing on producing more efficient vehicles and, of course, electric vehicles as well. It does, however, mean we have to focus on two near-term risks. So while this is all suggesting by 2030 we may see peak demand, I do highlight some cautions. Of course, the trade wars create new uncertainties, disruptions to production lines, how fast the new technologies will transmit through, and of course, the new technologies require new inputs, lithium, cobalt. I don't know about what you guys think about cobalt, but as a political backdrop for something that is socially and economically not very tasteful for most of the world, issues around cobalt could be a big issue constraining the growth of battery consumption going forward. So do not assume it's all even flowing. And of course, IMO 2020 is around the corner, and that is increasingly shifting the sort of demand for high-grade heavy sulfur fuels and low-grade heavy sulfur fuels and high-grade light sulfur, lower sulfur crudes. We are seeing the shipping companies are going to have to move towards using low sulfur fuels. Refiners are moving towards using more low sulfur crudes. and it's producing this big split on prices. Undoubtedly, it's also currently driving up freight costs globally as shipping companies have to invest in new infrastructure to deal with this or use more expensive fuels. So two takeaways from this is very highlight and very quick. One, freight costs are going up and not coming down anytime soon because of higher fuel costs. Also around higher capital costs of using new technology, including new ships, LNG ships. But watch that spread. We now see those dirty sulphur sludges become incredibly cheap. Good chance a lot of that end up in power stations, which have scrubbers. The demand for crude in power plants may actually rise in the short run. Another thing to watch out too in terms of what this also means is why aren't the US fighting hard against this? They are, but not like other issues. I will get to that in a minute when we talk about US production. So right now we are talking about OPEC production becoming marginal. It still matters picking short-run volatility, but as you can see, the growth has always, in the last years, has always been non-OPEC production. They are the new marginal producers. US frackers are what gives you that last barrel of oil to meet demand. They set the price now, not OPEC. OPEC can play on the edges. US is the main producer. And even as the growth of US production maybe slows over the next few years, other non-OPEC production is starting to improve. So yes, on this basis, we are talking about the US in the next couple of years, sometime during 2020, becoming a net exporter of crude rather than a net importer. Why did I mention IMO 2020 in the US? US exports light crude. IMO, US imports heavy crudes for its refineries built during the 70s. Why does this matter? The US will be importing cheaper crude, whereas they'll be exporting higher value crudes. Now, I can actually, this is my personal reason why the US is not fighting that hard about IMO 2020. Net, they stand to win. And of course, OPEC has been trying hard, and even with the benefit of the embargoes on Iran and, of course, Venezuela falling off a cliff in terms of their political environment, this has not done anything to help rebalance the supply and demand situation. It remains in a balanced situation, leading to oversupply. In a softer global environment, you can see why oil prices remain to the downside. And of course, it does raise one more, which we talk about LNG. LNG is still the rising sort of transitionary fuel for a lot of regions in the power stations. It is going to have increasing demand across the world, and it's undoubtedly so. But it is incredibly price sensitive. As we saw what happened in Europe, as gas prices moved higher, they shifted to alternatives, including coal. And lo and behold, as gas prices went higher, US, which has now actually been locked out of China because of the trade war, is importing a lot more gas into Europe. We've seen prices fall quite rapidly. Yes, gas prices, this is just a very simple chart highlighting price of gas, the change in average demand over a 5-year period, and you can see it's gas prices in Europe and the US and UK are very, very price sensitive. The US entering the market has helped increase the demand for gas because of lower prices, but it's holding the prices down. So be very careful about how much upside you would like to think about from gas given stronger demand. It is a price-sensitive mechanism in the global environment. And of course, the world, including Japan in particular, which is a big importer of gas and is actually not very happy about the fact that the gas prices are indexed to oil, are now looking for alternatives, including indexing to coal. And this is one way the Japanese, as consumers, are trying to offset this sort of imbalance that's occurring for them, where they don't want to build more coal-fired power plants, but they're incredibly cheaper to run compared to gas. And so they're trying to nexus the gas prices back towards around coal. And as we see more carbon price come through, you'll actually see this pressure on gas index contracts as well. So that's where we're living. Our forecast very quickly just highlight that the RBA will be cutting rates this year. That's the slower growth profile we're talking about. We've got 2 more cuts here coming through. Fed funds, we've got 3 more this year, whereas another couple coming up to that. That holds in the global interest rates. And of course, in that environment, there is a one upside, and that's the weak Australian dollar. On the Australian dollar front, this is just our model that highlights currently, given around commodity prices and net debt, Aussie dollar should be much higher. We are low because we're seen as a higher risk asset now in this environment, global uncertainties, our global slowing economy, Australian banks being highly leveraged into a housing market, which is seen as uncertain, is giving us this Aussie dollar, which is weaker than usual. That's our saviour. That's what gives us for nothing else, record high gold prices and, of course, better commodity prices overall. Our forecasts are in there, but I will actually have to quickly highlight Westpac IQ is where we live for our research, and I do have to quickly do our disclaimer, which is, of course, goes across the board. I will ever highlight just my own personal disclaimer. Those long run, those prices we're doing is trying to encompass what we think is the most likely scenario. We are talking about a slower global growth environment. We are talking about growing supply environments. But those uncertainties around the changes in technology, the types of resources we need, and how that'll impact on those changing environment, along with this growing trade imbalances, which produces a new global environment, produces a greater degree of uncertainty and a greater degree of risk around it. And I'd caution anyone going forward from here to be very cautious about being too confident about one particular scenario. So on that note, I'd like to thank you very much.